What's going on, people? Today's video is a bit different. It's basically me talking through one of my career guides, the asset management one. If you want to buy the guide, you can do so through the link in the video description. And if you want to join my summer internship career accelerator, where I'm going to personally help 100 of you who have a summer internship convert it into a full-time offer, hit the second link in the video description below to register your interest. With that, let's get straight into the video. What we're going to do today is walk through this guide. We won't touch on everything. There's a few things that are more interesting than other parts. So an introduction, roles, salaries and benefits, progression routes, titles and responsibilities, etc. How to break in, blah, blah, blah. The guide is quite extensive. It's 71 pages. But I thought, you know what, let me just walk through it in this video, and it could be a good introduction to anyone that wants to break into the industry, anyone who's thinking about doing an internship or doing a spring week, or will apply. This could hopefully give you a head start. If you want to buy the guide, it's going to be linked in the first link in the video description below. But with that, let's get straight into it. Let's touch on introduction. So what is asset management? Essentially, asset management is, I'm not going to read through word for word, but I'm going to just give you basic overviews of the points that I'm going to talk about. So asset management essentially is managing money for large institutions, so large companies, managing money for governments, managing money for any company or organization that has a ton of money that needs to be invested. So when you think managing money, what does that actually mean? Let's say a company has millions of dollars just sitting on its balance sheet. It's not doing anything. Typically, if money is just sitting idle, it's at risk of losing its value through the cost of inflation. You can invest it and get interest on it. There's lots of reasons why you would want to invest capital. But essentially, that's it. Asset managers manage money where money needs to be managed on a large scale. That's it. In asset management, you've got tons of different roles. You've got portfolio managers. You've got research analysts, traders, client relationship management, etc. We can go through them one by one. So portfolio managers are individuals who are managing the investments or managing the risk of investments. So for example, a portfolio manager is going to be responsible for managing money that is invested in equities and stocks. There's going to be a portfolio manager who manages money that is being invested in the debt markets, so in bonds, in mortgages, etc. Financial markets have lots of different asset classes, right? So you can invest in tech stocks, you can invest in debt and government debt and bonds, you can invest in alternative asset classes such as private equity, hedge funds, etc. You can invest in cryptocurrencies. All of these are different flavors of the financial markets that you can invest in. Each of these asset classes are going to have, like an asset management firm is going to have a product that invests in each of these asset classes. The product that is being invested, or the product that invests in these asset classes, is going to be managed by a portfolio manager. So the portfolio manager's role essentially is to manage risk. So let's say there's a product that invests, let's say there's an asset manager and they've got a product that invests in cryptocurrencies, and they've got lots of different clients who are giving different sums of money to invest into that product. It's going to be the portfolio manager's role to manage all of that money and make sure the investments that the portfolio is doing in cryptocurrencies are gonna hopefully get a return according to that product's return objective, making sure he or she is managing the risk of that product, making sure they are basically just ensuring that the product does what it says on the tin. A cryptocurrency product or portfolio is going to probably be more risky compared to a bond product, a fixed income product. Whenever you hear the term fixed income, just think typically it's safer than equities and cryptocurrencies. For example, it's debt focused, so it's government bonds, debt. It could be emerging market debt, it could be high yield debt, which is high yield means higher return. Higher return often comes with higher risk, so it's more riskier debt, and all these things. So the portfolio manager who is managing a fixed income portfolio, their responsibility is going to be to keep track of what's going on with interest rates, what are governments doing relevant or relative to their product, how are they going to manage the fixed income portfolio to make sure it gets the 2 or 3% return that it promises for its investors. So let's say I'm a client, I'm a company and I've got tons of money that needs investing. I'm going to decide, do I want to invest it in a cryptocurrency portfolio, or am I going to invest it in a fixed income portfolio? Yeah, so let's say I go with the fixed income portfolio because I'm risk averse. I want to get a 2 or 3% return for the year. I will give the asset manager $400 million to invest for me, and then it's their role, the portfolio manager's role, to decide how best to invest that money over the next 6 months, year, 2, 3, 4, 5 years to get that 2 or 3% annual return. And then the asset manager takes a fee, so they take a bit of money. It could be, they talk in basis points. So 1 basis point is 1/100%. So they would charge like 0.5% or even less than that on the total sum. So if a client is investing $400 million, 0.5%, so 1% is 10% is 40 million, 1% is 4 million, so $2 million. That's essentially how asset managers make their money. They charge fees on the total sum being invested. And then they also, on the more alternative types of products, the more riskier types of products, they say, look, we charge a management fee, so that's the fee we take as a percentage of the overall sum just for managing your money. However, if we make you a certain amount of money, we're going to share some of that profit with you. They're going to take an extra percentage based on if they perform really well with your money, basically. And that's something we can touch on later. It's included later on in the guide as well. That's portfolio managers. All right, research analysts. So what do research analysts do? Research analyst role is going to be working closely with the portfolio manager. They are going to be coming up with research and ideas on where to invest or where there are opportunities in the markets. So there's going to be research analysts in equities, research analysts in fixed income. Across all of the different asset classes, they're going to work with the respective portfolio managers to come up with ideas, trade ideas, just sharing news and information that they think is important or important relative to the portfolio that's being managed. Research analyst works closely with portfolio managers. Yep. They use various tools and resources to gather and analyze data, including financial statements, economic reports, and news sources. They are basically the right-hand man or woman of the portfolio manager in order to make sure that the portfolio manager is making informed decisions when it comes to managing the risk of the portfolio. So research analysts typically have like a economics background. You can have any background to work in this industry, but it helps if you've done like economics or if you like writing long essays and stuff like that. All right, next we've got trader. So the trader, so research analyst does a lot of research. They share their ideas with portfolio managers, but when the portfolio manager decides, all right, let's get rid of these investments or let's adjust in this way, that money needs to be allocated into the financial markets. It needs to be used to buy and sell financial securities. Who does that? The trader does that. So trader in asset management is execution only. They're executing trades rather than coming up with ideas to trade to make the firm money. That's more of a hedge fund trader, where they are responsible to come up with unique ideas to make money for the firm, whereas in asset management it's execution only. They're trading so that the portfolios can perform well for their clients. It's a lot less intense being a trader in asset management than it is being a trader on like the sales and trading floor in global markets or a trader at a hedge fund. Client relationship manager. All right, so we've talked about how all the money comes in. No, we haven't. We've talked about how the money gets invested by portfolio managers, right? How the traders, so traders, research analysts, portfolio managers, very technical. But how does that money come into the firm? That's where client relationship managers or salespeople come in. They are essentially client relationship managing. They are responsible for going out and meeting clients. So salespeople are responsible for pitching to clients. Let's say the asset management firm has a new product, a new portfolio that invests in a certain asset class. It's the salespeople's role to go and pitch that product to their clients, to existing clients, to prospects. When we say prospects, we're talking about potential clients. So to anyone or any firm or institution, insurance company, pension fund, government who has money that needs to be invested, it's the salespeople's roles to build a relationship with them, because essentially that is where business comes from. Salespeople work with clients, clients invest money with the firm, money gets invested by the technical people, portfolio managers, traders, research. Risk manager, so this is more of a middle office role. Risk manager works closely with the technical people, the traders, portfolio managers, research analysts, and they are basically making sure that, you know, nothing is going wrong on the back end, making sure that the front portfolio manager, traders, etc. are doing everything within the limits that that portfolio or that product is set out to do. They are responsible for making sure it doesn't take on excessive risk, or, you know, they catch anything that goes wrong. That's the risk manager's role. Compliance officer, what do? This is more of like a back office role. They are basically the police officers of the firm, police officers of the division. They make sure if anything goes wrong, they catch it. They make sure if there's any insider trading or misuse of funds or anything that's not meant to happen within the firm, they make sure they catch that and deal with it. They are basically responsible for making sure the firm's or the division's reputation and work is all legit and legal, and nothing goes AWOL, for lack of a better word. Operations, these people are also back office. They make sure, like, once a trade is executed, it goes through a long system, right? Like, you're dealing with hundreds of millions of dollars. It's not as simple as me sending you £100. There's a system that it goes through, and there's a lot of things that can go wrong. Operations people work closely with traders and risk management to ensure that everything flows smoothly. Without operations, the whole of the front office can't really work properly. So they make sure the engine is oiled. They make sure everything's going all right, so that the front office can do their thing. Then you've got human resources, HR basically. So some people in HR deal with campus recruitment. They go to universities and do talks to try and get students to apply to the firm. Some people in HR deal with salaries. Some people in HR deal with morale, making sure people are okay in the firm. A lot of people in HR are working closely with managers and managing directors and VPs in the different divisions, in front office, in asset management, etc., to make sure that they have a good recruitment pipeline coming through. So HR do lots of different things. Okay, those are some of the most common roles in asset management. Other common roles in asset management may include marketing professionals. So whenever, like, the salespeople are going on a roadshow, they're taking this new product to clients and they're doing events and stuff, you need marketing professionals to help you out with, like, the marketing materials, updating the website, making it look good, all of that. You've got investment strategists. They work closely with the technical professionals. So the technical people are basically called investment professionals, and then you've got the salespeople, and then you've got everyone else. Support, for example. And you've got financial advisors. So these are more common in private banking, private wealth management. I've got a whole guide on that. You can check it out. It will be linked below. All right, how long has this been? 15 minutes. Okay. Other common roles in asset management. Nope, we've touched that. All right, portfolio manager, research analyst, trader, blah, blah, blah. What's next? All right, let's go on to salaries. All right, how much money can you realistically make in asset management? All right, salaries in asset management can vary depending on various factors. The size of the asset management firm. A larger firm tends to offer higher salaries, but this can also be true for more boutique and niche firms, because they will typically have smaller number of employees. So let's say big firms like Goldman Sachs, JP Morgan, Goldman's got like 30,000 employees, JP Morgan has like 200,000 employees. And so, you know, that's a lot of employees, that's a lot of headcount. Versus a few boutique asset managers or smaller firms which might have 200 to 1,000 employees, that's less headcount. They are obviously going to be making less revenue and profit, but, you know, sometimes smaller firms can pay you better than bigger firms. That's why you get a lot of people moving from established firms like JP Morgan Asset Management, Goldman Sachs Asset Management, moving to boutique firms, specialist firms, who just focus on something that they're interested in. It might be sustainable investing, investing in charities, investing, you know, in insurance companies, whatever it might be. So let's say you break into asset management, and you're doing your thing, and then you realize you're actually more interested in X asset class, let's say cryptocurrencies. It might make sense for you to move after a few years into a cryptocurrency focused asset manager. So an asset manager that doesn't do everything, they just do crypto, because that's more specialized, that's more interesting to you. If you do that, it will probably unlock better opportunities for you You can have more responsibility. You'll be a bigger cog in a smaller wheel. So a smaller firm, you'll play a bigger role versus a tiny cog in a big firm. And so that's often why people move. Location is a factor. How the market is performing. You know, are we in a recession or a downward spiral cycle right now in the market, or is everything booming? Is everything going well? That affects salaries as well. But yeah, like mostly portfolio managers earn or have the potential to earn the most in asset management because they're kind of managing portfolios. It's up to them. Like they are responsible. It's a team effort, but they're responsible for making sure the portfolios do as they say. If the portfolios perform well, they're going to get a nice bonus. It makes their clients money, makes them money, makes the firm money. Great. If they don't do so well, they're going to get a smaller bonus, sometimes no bonus. Sometimes they might get fired. Research analysts, so portfolio managers, you can start anywhere from 100k depending on your seniority up to 400k, and then your bonuses can be multiples of that, right? However, in asset management, in big asset managers, they aren't going to be like the difference between asset management firms and let's say hedge funds is that hedge funds look to knock the lights out. They look to swing at bat and send the ball out of the stadium. They are very risk loving in order to get a very high return. Asset managers, it's less so the case. They have products that are more risky than some, but for the most part, they're not operating like a hedge fund. They're not trying to get like 16-20% returns on all their products. And so as a result, the upside of a portfolio manager's bonus is going to be somewhat limited because they're never going to try and get an extremely high return. Whereas at a hedge fund, portfolio managers are meant to try and get a really high return. If they get that, they get a really high bonus. So that's something worth considering. Traders at a hedge fund, similar story. Like your potential to get a bigger bonus is higher at a hedge fund because you're looking to knock the lights out versus an execution only trader at an asset manager. Salespeople, so salespeople are going to get less than investment professionals. However, if you're a top salesperson who's bringing in big clients to the firm, you're going to get a big bonus. You're going to get recognized for that because it works like this. If you're really valuable in any industry, in any role, in any seniority, if you're really valuable to the firm, they're not going to want to lose you to a competitor, right? I just realized I didn't even plug my proper mic in, so I don't know what the quality of the mic is going to be for this recording. Anyway, that's something I can learn for the next video. If you're valuable to the firm's not going to want to lose you to a competitor, and so they're going to try their best to keep you. How do they try and keep you? They will be giving you a bigger base salary, bigger bonus, bigger long-term compensation, incentives, stock options, equities, etc. All right, and then you've got some of the other salaries there. Benefits. All right, so when you join an asset management firm or any investment bank, for example, what are the benefits you can get? So they sort you out with health insurance. It's usually banging. It's really good. Private health insurance, private healthcare. Their pension plans are very good. They look after you. They match you or put some on top. Bonuses, obviously. Financial services typically offer you the largest bonuses compared to any other industry. Like if you join financial services and you have friends in other industries, when they talk about their bonuses, you're going to think, oh wow, I have it really good compared to your bonus. Paid time off. I mean, in America, the culture is like you get like 10 days off a year, and people frown or look that like people don't rate you if you take those days off. Like it's looked down upon. Like the culture is quite like it's very work heavy. In the UK, you have it a bit better, and Europe, like it's more relaxed compared to the US. But yeah, I think like in the UK, 23 to 25 days off a year. In the US, it's like 10, 11, 12 days, which is nuts. Pretty standard, I think, in the UK, Europe. Professional development, they always host these events. They bring people in. You get to see interviews with like industry leading professionals, CEOs, founders, movers and shakers, basically. Flexible work arrangements. Old school firms, some of the more serious, like I say serious, some of the more old school leaders want people in the office 5 days a week. Some firms do hybrid model, work from home 2-3 days a week, be in the office the rest. Flexible work arrangements, that's something that could be a perk or a downside, depends how you look at it. And then other perks, like you get discounted gym membership, you get salary sacrifice schemes, so you can like buy or invest in a bike through the salary sacrifice scheme. So what does that mean? So it means if you get paid, so let's say you get paid here that much, and then you get taxed, then you're left with that much, and then you have that much money to spend on a bike. There's schemes where you can spend money on a bike to travel to work, for example, but with your pre-tax income. So with money that would usually get taxed. So you save money basically. So you buy the bike and then you get taxed, and then so that you save a few £100. All right, progression. So typically this is the route. Entry level, you do your spring week, you do your internship, and then you graduate, you become an analyst, right? And then after a few years, so that could be 2-3 years as an analyst, and then once you show them you're capable and you've performed well, you become a associate. You're typically an associate for 2 years, and then you become a director or a vice president, and then not everyone makes it to managing director. Only the cream of the crop, and that's typically, if you do it quick, that's 7 to 8, 9 years. Most people, it takes them more than 10, 12, 13 years to become a managing director. But most people in the industry are actually VPs, vice presidents or directors, and most people get to that position. They don't want to, they're either not good enough to become managing directors, or they're comfortable in that position. It pays extremely well. They've got it good. They're happy there. They're not worried about climbing anymore, or leaving. So most people end up in that position and they just stay there for most of their careers, unless they move to a competitor and then either stay in that same position or try and climb. All right, titles and responsibilities. So what do you do as an analyst? As an analyst, you're going to work under the guidance of more senior team members. Okay, so you're going to be conducting research, you're going to be getting data from online and using it to create Excel spreadsheets. You're going to use it to create Microsoft PowerPoint presentations so that the senior people can go to meetings and use that. You're going to be creating pitch books, you're going to be creating models on Excel that the portfolio managers can use and the research analysts can use when it comes to deciding products or asset classes or financial securities to invest in. You're basically doing all of the grunt work. You're going to be analyzing financial statements, so on and so forth. It's your responsibility to stay up to date with what's going on in the industry, specifically your specific asset class. So as an analyst, you're going to cover, if you're an investment analyst, so technical, you're going to cover a specific asset class. You need to know what's going on in that asset class. So if you're doing equities or crypto, you need to kind of be the go-to person on that space, because that's an easy win. If you know everything what's going on in your space, then people are gonna come to you to get the lowdown or get an update on the latest news. How does the latest news impact the portfolio that you're covering, etc. And then as a salesperson, look, your salespeople are more generalists when it comes to asset classes. You need to know a bit about everything because your clients are going to be interested in a bit of everything. So you need to have a good base level understanding of the different asset classes. More importantly, the products that your firm offers. So your asset management firm is going to have a flagship product in fixed income, flagship product in equities, crypto, alternatives. It's good for you to have a lowdown, have the key information on the firm's key products. So when you go and talk to clients, they might say, oh, we're thinking about investing in equities, or we really like what's going on in the fixed income space. Then you can talk about your product. You don't want to be too salesy or too pitchy, but it's good to have that knowledge. The more technical knowledge a salesperson has, the more of an asset they are to the firm, the more impressive it is. And that's why some salespeople go and do the CFA. The CFA is a qualification, the Chartered Financial Analyst, and it basically makes you stand out. Associate, all right, mid-level position, works closely with asset managers. When you become an associate, you kind of step away from most of the grunt work. You get analysts beneath you that you can delegate work to, so then you can start taking on client meetings on your own rather than shadowing someone senior and just taking meeting notes. You become more of a junior portfolio manager. You're able to start trading. You're able to do more work that has an impact on the bottom line, basically. So you get more responsibility and you're given more independence to take your own initiative. So that's associate. And then vice president or director, that's when essentially you're going to be probably managing a team of 1, 2, 3, 4 people. you have a lot of decision making capabilities, you're responsible for a lot more. And then managing director, you're managing a full team of directors and associates and analysts, you're setting strategy, you're basically a key decision maker, you're a person of significant power and responsibility within the division or the firm, and it's up to you. Like if a portfolio does well, you know, you'll get a lot of credit. If it doesn't do well, you'll get a lot of stick. And this, at these levels, your compensation goes from just a salary and a bonus to salary, bonus and stock options, because if you're good, the firm's going to want to keep you. So they say stay with us for another 3 or 4 years and you can unlock all these equities or stock options so that you stay here. Otherwise, if you leave early, you're going to forego or give up these stock options, and so that's how the firm kind of aligns incentives for you to stay at the firm. Positives, let's see. Some of the big asset managers, top 20 largest asset managers. You've got BlackRock, largest asset manager in the world. You've got Vanguard, UBS Asset Management. I would advise you, if you're watching this video, you should do an application to all of these firms. If you're a first year uni student, apply to their spring week programs if they have one. If you're a second year, third year uni student, or if you can apply to their internship, apply to all of their internships. And yeah, if you're a graduate, apply to the grad schemes. Alright, let's see. What have we touched on? Once again, if you want this guide, go to careerguides.io. I've got all the guides on the different divisions, but this one specifically, I'll link it in the video description below. Clients, networking, cover letter. I don't want to run this video too long. We've done 29 minutes, but yeah, if hopefully this was useful. Let me know if this type of video is useful, because part of me is like, I've got all these guides, I've got all this knowledge and insight that I could do these types of videos on, but I want to know if they're useful for you first before doing more of them. So let me know in the comments if they are, and I will see you in the next one. Peace.